Welcome to the WAM Leaders Investor Conference Call. Chairman Jeff Wilson, Portfolio Manager Matthew Haupt, and Senior Equity Analyst John Orb will be leading the call today. Then they will cover some of the pre-registered questions, and then we will open the call to investor questions. Chairman Jeff Wilson will begin. Please go ahead.
Look, thanks very much. And first of all, thanks everyone for supporting us in terms of being shareholders in WAM Leaders, and secondly, spending some of your time calling in today and sending in the questions. And what we'll attempt to do is, in the presentation we give you to cover off a number of the questions. If not, we'll do them at the end. In terms of WAM Leaders, you all know, or you may not know, that it exceeded our expectations in terms of how much money we thought we'd raise. The company started trading on the 30th of May, and in terms of, from an investment perspective, we are pleased with the performance to date. The share price, $1.10 issue price with a 1-for-1 free option. The shares are trading around that $16, $17, and if you add the option, 6.5 cents. So the package is people ahead 12 to 12.5 or 13%, so we're pleased with that. In terms of the underlying portfolio, the boys will touch on that and its performance a little bit later in the conversation. And obviously they'll talk about some stocks. What investors continually talk to us about, and we think are very interested, is in dividends and dividend policy. Now, obviously the plan is to have a growing or consistent stream of fully franked dividends to be able to pay to shareholders. These decisions are board decisions. Obviously our first really half-year period is the period to December, and then the board will review how the portfolio has performed, what our level of franking is, and what the dividend policy will be. It will, in terms of dividends, it'll take a little bit of time to build up a good level of franking and a good level of profit reserve. So it's worthwhile to be aware of that. Someone did ask a question about comparing this dividend to FGX and FGG, which are two other entities that we've been involved with that have a charitable purpose. Now, the WAM Leaders' dividend policy will be different to theirs. The WAM Leaders' dividend policy will be more in line with the WAM Capital dividend policy. But you've got to remember, WAM Capital's has built up franking and profit reserves over a 17-year period, and WAM Leaders are just starting. They're the main things I want to cover off on. Just one thing, the reason we're having this call is because to keep costs to a minimum, and that's what we like to do. We didn't prepare an annual report. We could have, in theory, prepared. We got a waiver. We could have prepared an annual report for 1 month's trading, but we thought that was just a waste of shareholders' money. And we thought, as we're not having an AGM to correspond with that annual report, and the next time we'll see you is when we do the 6-monthly roadshow. We thought would update you. So that's the reason for the call. So now I'll pass over to Matt and John, and Matt will take it initially. Thank you.
Great. Thank you, Jeff, and good morning to everyone on the call this morning. I'd like to draw your attention to slide 5, which, if you've got the presentations handy, it goes through our top holdings. So it's the top 10 stocks in the portfolio currently. And if you do the maths, if you've been following these stocks, you can see for the month to date, that top 10 there has returned a little over 1% for the month to date. Going through the stocks there, John will talk in detail around 4 of those stocks: Aurora, Credit Corp, Aristocrat, and Reliance. So I'll just touch quickly on Aurora because it's the top holding there. That is a company that was spun out of Amcor a few years ago. They released their results on Monday, beat expectations, and rallied strongly on the day. So they're up about 15% for the week. So that's been a great performer. But I'll let John run through that a bit later. The second stock there, ALS Group. The reason why we like this stock at the moment is we think we're in the midst of a recovery in the mining sector after a very tough few years there. A lot of mining companies we have spoken to have raised money just recently and starting to explore again. And also, existing miners are increasing volumes, which has been quite a steady trend over the last 12 months. So we think ALS is a distinct opportunity here when they can increase their margins. So they have margins around 10% at the moment. Back in the boom, they're around 30%. So even if they double their margins, we think there's significant upside still to this stock. Another one you can see there going down the list is James Hardie's. The reason why we like James Hardie's is we think the US is still in the midst of recovery in their home building starts. So traditionally the US do around 1.5 million starts a year. We're currently sitting at 1.2 million starts. So we think there's still upside here left in the cycle with James Hardie. And they are really in a dominant position in their fibre cement market. They have about 90% market share. And we think they will continue to see good volume growth. They came out with their results for the first quarter last Friday and had 16% volume growth. We think the big impact will be through pricing. So we've seen the volume impact, and we expect to see pricing impact over the next few months on James Hardie's. Another stock I'll touch on there, on the bottom of the list there is Eclipse. We quite like Eclipse because the management team, we've known them for a long time. They used to be involved with Flexi Group, another ASX-listed company. We think Eclipse, will do quite well through a cost-out program, which they've sort of initiated over the past 12 to 18 months. Looking forward, they're starting to get some top-line growth, and that cost-out program is gaining traction. So we think there's significant earnings upside as well. And going forward, we think there's going to be industry consolidation, and we think Eclipse are in a prime position to capitalise on this. So this stock we're quite comfortable on going forward. If I turn your attention now to slide 6, we just thought we'd touch on the global market overview at the moment and outlook. As has been the case since the global financial crisis, global markets have been driven by accommodative central bank policy, and this has continued to be the driver. The accommodative policy has created distorted fixed interest markets and pushing up the valuation on risk assets. Post the GFC, there's been over 667 rate cuts from central banks and massive QE programs. Recent data I was looking at suggests there's around $13.4 trillion of negative yielding debt at the moment. This has caused a backdrop for a bull market in global equities and the current high valuations we see now. We thought with the Brexit vote in June, there'd be a perfect event for the market to sell off. But what happened was the global yields fell to all-time lows, and again, this pushed up equity valuations. So despite risk going up, equities ended up going up off the back of lower yields. So this trend is still holding, and we think that won't change for the immediate future. So since the Brexit vote, the Bank of England, Bank of Japan, Reserve Bank of New Zealand, the Reserve Bank of Australia have all moved rates lower. So again, this is very supportive for equity valuations in the short term. So looking forward, economic growth looks quite stable, still tracking below trend. Most central banks remain dovish, with the exception being the Fed, which look like they'll push up rates towards the end of this year. And I guess that's a good segue into some of the stocks we have too. We're quite bullish on the US recovery, and the stocks that have exposed there are Aurora, James Hardie, and Reliance, which you can see now, top 10 there. Europe remains a concern with potential banks issues in Italy, and the fallout from Brexit we still haven't seen come through in the data yet, so we're still waiting for that as a potential risk. Emerging markets still an issue for anything with US dollar strength, but we remain quite cautious on emerging markets. So we turn our attention now to slide 7, the Australian equity market. So looking at Australia, the domestic economy continues to go through a transition phase away from the booming mining sector to a more traditional economic cycle, with property and infrastructure leading the way. The Australian economy continues to grow at a moderate level of GDP growth with low inflation levels. The RBA, we think, continues to be in a loosening phase, which should be supportive of lengthening the current trends that we're seeing at the moment. On the Australian share market, we think it continues to look expensive, but believe this is likely to continue for the immediate future. The market is trading well above historical averages, so that makes us cautious, but still finding many opportunities out there. Earnings growth outlook for FY17, I think, will be mid-single digits at this stage, but we're still waiting to see a lot of companies report, because we're sort of 1 to 2 weeks into the reporting season at the moment. So if I talk about the trends we're seeing now in reporting season, it looks like top-line growth is still very difficult to achieve. Margins are holding, and earnings growth is still subdued. A trend that we saw in the February reporting period is holding true again. That is, companies that are on high valuations that don't meet expectations are being punished exceptionally hard. Companies that are relatively cheap, that meet or even just miss expectations, are rallying hard off the back of their results. This is a trend we're trying to take advantage of at the moment. And looking now at the outlook for companies through this reporting season so far, most are flagging low earnings growth. We think valuations at this stage look stretched and expect not too much in the way of equity returns across the market in general. That being said, though, we're still finding opportunities that meet our investment criteria. So going forward, I think the return for the Australian equity market will be in the mid to high single digits at this stage. But again, we're waiting to see all the companies report, and a lot of the companies report towards the end of August. So we'll be updating our views as the information comes through. So what I'll do now is hand over to John Ayu, a senior equity analyst on WAM Leaders, to run through some of the stocks in detail for us.
Thanks, Matt. Firstly, this morning we'd like to talk about 3 stocks that form part of our research-driven portfolio before turning to a stock that fits within our market-driven side of the portfolio. The first investment from the research-driven portfolio that we would like to discuss and we like is Reliance Worldwide Corporation, ASX code RWC. Reliance is a leading designer and manufacturer of water flow and control products for the behind-the-wall plumbing industry. With a current market cap of $1.7 billion, it trades on an FY17 PE of 27 times and with forecast EPS growth of around 27%. After a successful IPO in April this year, we continue to like this investment for a number of reasons. Firstly, we are attracted to RWC because of its strong and experienced management team, with an average tenure of senior management being well over 20 years. From its small beginnings in Victoria, Reliance has managed to build a global business, and that global business has driven an annual compound growth rate of around 13.5% between FY06 and FY15. Today, more than 75% of net sales are derived from outside Australia, with the bulk of those coming from the United States. We see further upside from the continued penetration of Reliance's core brass fitting products, branded SharkBite. This product utilises labour-saving push-to-connect technology and is broadly used in both commercial and residential applications. SharkBite is a market-leading product in Australia, US and Canada. Reliance first introduced this product into the United States 11 years ago, and today it has around 80% share of that category for residential applications. Further, Reliance is a leader in innovation and manufacturing excellence. With much of the current product suite exposed to the repair and renovate housing market, Reliance has developed a number of new products to open up opportunities to the new home built market in the US. One such product we are excited about is the in-house manufactured and designed and patent-protected EvoPEC fitting system. This product is due for release later this year and could provide a strong platform to tackle the new home build market in the US. Next, we turn to the largest position in WAM Leaders, Aurora Limited, ASX code ORA. As Matt mentioned earlier, it was spun out of Amcor and reported earlier this week and since then has returned 15%. By way of background, Aurora is a leading packaging company with operations in Australia and America. Its market cap is around $4 billion, trading on FY17 P of 21 times and forecast EPS of circa 16%. We really like the defensive nature of Aurora's business, with its primary exposures to beverage and food consumption. We all see Aurora's products on a daily basis, be it in beverage cans, boxes that carry our fruit and vegetable, or even the glass bottles that bring us our wine. Aurora are integral in every aspect of the delivery of consumables from manufacturers to consumers. Again, with a strong leadership team, Aurora have been able to drive cost efficiencies in the business and continue to win market share in all categories of operation. We continue to see scope for further cost opportunities to boost margin and to offset any input headwinds they may face from rising energy costs. Going forward, we are attracted to the potential for bolt-on acquisitions in the US to drive further growth. The recent acquisition of Integracolor highlights this, and it provides a platform to grow its footprint across the Americas in the point-of-purchase display market. We see Aurora as conservatively geared at present, and we see potential for them to deploy more than $150 million per annum in investments over the next few years to drive these growth opportunities. Moving over to Credit Corp now. This is a company we have followed for a long time. It's a buyer of Australian and US debt ledgers and has a personal loan book in Australia. We rate management highly and think they are in a prime position to capitalise on industry dynamics. Its market cap is circa $800 million with an FY17 PE of around 14 times, and we expect around 20% EPS growth. The reason why we like Credit Corp at the moment is we think that two of their three divisions can grow at a fast pace. The first growth division is the personal lending book. Credit Corp has recently ramped up their personal lending, and we are now seeing strong growth in this book. Typically, as a loan book matures, it becomes very profitable, and we think that we are approaching this stage now. We think that they can continue to grow the loan book with the current product suite, and coupled with the introduction of new products, we forecast that this could be as large as the more mature Australian purchase debt ledger book. Secondly, the second growth division we like is the US PDL business. Due to regulatory issues, the US PDL book has shrunk over $3 billion. The US PDL market, has shrunk by over $3 billion. As such, opportunities were scarce and pricing made it hard to compete for Credit Corp. We are now getting some clarity around the US regulatory environment, and we think the US PDL market could regain that $3 billion of volume per annum. Credit Corp have been disciplined through this period, and we think they can now compete and win a decent market share going forward. Again, we think this business can be the same size as the Australian PDL business. Now shifting quickly to the market-driven part of our portfolio, and one investment that has worked for us and we continue to like is Aristocrat Leisure, ASX code ALL. Many of you will be familiar with Aristocrat, but as a refresher, Aristocrat is a leading developer, manufacturer and distributor of gaming content, gaming platforms and systems globally. Its current market cap is around $10 billion, with an FY17 PE of 22 times and forecast EPS growth of around 20%. I'll start off by saying that the poker machine industry is very cyclical, and accordingly, companies that have invested through the cycle are typically rewarded with the lion's share of new sales. Over the past few years, Aristocrat have invested heavily in people, product design, and developed a game library that has resulted in a dominant market share position in Australia and an ever-strengthening position in the US replacement and participation markets. This product share has been driven by new products such as Lightnings and Buffalo Grand. These products are delivering results well above house average return, and accordingly, consumer demand for these products is driving that market share movement toward Aristocrat away from some of the larger US competitors, many of whom have their own balance sheet issues. We believe that their game library bank will continue to drive that market share growth for the coming years, and we see their ability to pull the price lever to help drive margin improvement. Further, we also attracted to the social gaming side of the business that has generated more than 100% growth over the past few years. Recent comparable transactions in this space, in the social gaming space, I should say, highlight potential growth and valuation upside there. So that's all I'll touch on at the moment. I'll pass over to Alex Hoppe, our Senior Communications Advisor.
Thank you, John, and thanks everyone for dialing in. Shareholder communication is extremely important to us, and we do this through our weekly email, monthly NTA reports, half and full year results, obviously our website, media, independent research, investor calls like today, and our monthly investor roadshows. Our next investor roadshows are coming up in November, beginning in Adelaide on the 16th and ending in Brisbane on the 24th. A full list of dates and venues is available on our website, and next month you'll be receiving an invitation to these presentations in the mail. I'd like to cover off some of the pre-registered questions now, and then we'll open the call to any other questions following that. We've received a few questions regarding options and both the use of options in the portfolio and options outstanding in WAM Leaders. Matt, did you want to touch on that?
Yeah, thanks, Alex. As far as options go, the use of options within the portfolio is not within our mandate. So within our mandate, we don't have the ability to trade options, write options, and there's no gearing. So as far as options within the portfolio go, that can't happen. The other question we had in was regarding the outstanding WAM Leaders options, which are trading on the market. So those are still available to trade, to buy and sell or exercise. They have an expiry of November 2017, and we'll be sending regular updates around dividend dates. So if those people wish to exercise options before the potential dividend dates, we'll be sending reminders. So that's an update on the options at the moment.
And we also had a few questions regarding our current cash weightings. Matt?
Yeah, sure. Cash weightings at the moment, you would have seen at the NTA, we have around 30% cash. How I see that fluctuating around at the moment, I think the equity weightings we have now we're quite comfortable with. And during reporting season, there's quite often trading opportunities. So I'd expect our cash weighting to decrease over the next week or so. And then I think going long term, if I look long term, the WAM products traditionally have around 35% cash. I think WAM Leaders will be around that 25 to 30% cash level over time. So I think it'll be slightly more invested given the liquidity potential of the top 200 stocks. So I think that's how our cash weightings will play out.
Thanks, Matt. And we've also a question around liquidity and position sizing in the portfolio. Matt or John, did either of you want to take that one?
I'm happy to answer that one. As you can see from our top 10 holdings that we released this morning, we found it quite, liquidity quite accessible, particularly in those top 100 stocks. And one of the original reasons that we launched WAM Leaders was basically to find those more liquid markets. Even so, beyond that top 100 space, in a name like Credit Corp, which is a stock that we like as a group in total, we were able to source sufficient liquidity to get to our target weighting of that around 4% of the portfolio. So we have been able to size the positions rightly, and we continue to work towards target weights across the portfolio. So the strategy today has worked well.
Thanks, John. And now we'd like to open up the call to any questions that you may have.
Thank you. We will just stop the recording now.